Welcome back for this next session in the A4S Summit. We're going to be exploring some of the key actions that we need to finance the future. What are some of the barriers and what are some of the solutions? And I'm really pleased to be joined first by Sarah Youngwood. Sarah is the Executive Vice President and CFO at Nasdaq. And she's got more than 25 years of leadership experience in corporate finance, reporting, investor relations, treasury, corporate finance, and some of the broader finance roles. She joined Nasdaq from UBS Group, where she was also CFO and group executive board member. And prior to UBS, she spent 2 decades or more at JP Morgan Chase in a number of executive roles. So she brings a huge wealth of experience from across the capital markets. So I'm really looking forward, Sarah, to hearing some of your insights in terms of some of the trends that you've seen, the actions that are happening now, and how we can really fast track action into the future. So welcome, Sarah.
I'm thrilled to be here, and it's not my first year.
No, indeed. Well, you've been involved in A4S's work formally for the last few years. So really looking forward to some of the insights that you can share. And as you know, this year is A4S's 20th anniversary. So one of the things that we're quite keen to do is look at some of the progress we've made over the last 2 decades and the challenges we're experiencing now and how we can really fast track action for the future. And for this session, really focusing in on the role of the capital markets, which of course in your current role at Nasdaq, in some of your prior roles in the banking sector, you've seen from a number of different perspectives. So really looking forward to that, those thoughts. To get us started, can you share your thoughts? So particularly thinking of some of the biggest areas of progress that you've seen.
Yeah, and first of all, I'll start with my lens is 2 large banks, UBS most recently and JP Morgan before that. Very international, very global, both of them, leaders in what they do, and one exchange. And in some ways, when you think about that lens, the banks and the exchanges, as well as the asset managers, have the role of being a corporate themselves, but they also have the role of connecting corporates with the capital. Everybody wants to be funded, everybody wants to be financed, everybody wants to be owned. And therefore, there is an additional level of intensity that comes with that perspective. And I'm very glad to report just on progress that when I look at it with those lens, there has been tremendous progress. First thing is like everybody has made commitments pretty much. And that has been important. Disclosure is going to continue to evolve, but disclosure is starting to become very important and is coming to have a lot of rigor. I think that's also very good. Regulators have done their part in asking for a lot of disclosure. I believe that that is very important because transparency is something which at Nasdaq we're very focused on. And lastly, I would say people believe in it. And I'll give you just two stats to get us started on that. And Teneo did a survey, and 92% of the CEOs want to stand by their ESG programs. And that is really, really important. So programs, agendas are in place. Whether people are executing everything tomorrow morning or not is not the question. The second thing is investors are interested in it. And 60% of investors believe that the climate-related disclosures actually have a positive impact on the reputation as corporates. And so when you look at it from both sides, a lot is happening and a lot is appreciated. So I think that's tremendous progress.
I think that I would totally agree with that. I think we've seen, as you say, that commitment, even in just the last few years. When we first started A4S 20 years ago, it really wasn't there. And even 10 years ago when we started the CFO Leadership Network, of which, of course, you're now a member. But we know that there's still a big gap. And I think in the last few years, there've definitely been steps forward, but there's also, almost as a result of that, being quite a lot of pressure in different directions from some who say collectively we're not moving fast enough, and from others who feel like the speed of change is just too much. So if we look at that gap between the kind of commitments that we know we need to deliver on and the actions that are currently being taken when it comes to achieving those outcomes. Can you say a little bit more about the kind of barriers that the finance world is facing and might sit behind why there are some of the gaps that we see?
Yeah, so I'll look at it from a CFO, and I've defined the CFO as the person in the organization who helps to make the right decisions, execute on the decisions, and then tell the story of those decisions. And so if you look at the first lens, which is making the right decisions in ESG, which I think is crucial, one of the things which is a barrier is the inconsistent frameworks. I do a lot out of return on invested capital, very, very important. But if you start with the first thing about doing an analysis of return, you need to have a discount rate. And whereas at A4S, you have been a huge proponent of having a true rigor on that. And we very much welcome your leadership here. This is not something that is well defined and well accepted in a consistent manner. Second thing you need if you want to do return on invested capital as your decision framework, you need good data. And the data right now is still being accumulated as an after the fact. It's not embedded at the source. And therefore, there is, of course, a lot of progress, as I mentioned initially, that there is data to look at. But it's not yet at the level where it needs to be sure that we're looking at all of the facts to make all of the right decisions. Then in terms of like the execution of those decisions, well, technology is something that I believe in. And of course, at Nasdaq, we truly want to make sure we get to scalable technology for ESG. And so whether it is in terms of like reducing carbon impact itself, for example, through Pure Earth, we have a nascent carbon removal standard. It is a standard though, and bringing all of the elements of true marketplace, liquidity, transparency, integrity, and scale to that technology is going to be really important. And if I look at also execution in terms of like how to let all of the corporates get it done, but get it done easily, use technology. And this is what Gen AI is going to bring. We have lots of solutions that are going to help with that. And I really think that whether it's us or others, it's going to be very important that we lend technology to make sure that people can execute at scale on ESG. And then to tell the story of those decisions, again, there are ways to do it more efficiently. And so, for example, whether it's a Nasdaq Metrio report that enables you to gather your information or some other tools that we are giving, it's very important that people have very easy ways to integrate into how they are doing ESG, the tools that make it easy to do so that they can go back to making the right decisions and having more of an impact.
So I'd love to unpack some of those barriers and some of the examples there a little bit more. Maybe starting, as you mentioned at the beginning, you have a few different hats that you could wear or a few different lenses that you see the same challenges from. So maybe starting with that perspective from the capital markets angle, so the users of the information that gets disclosed by companies, and in a Nasdaq world, you're kind of at the heart of that information exchange. What are some of the things that you would like to see or that you feel will help to close the current information gaps that you were touching on, and enable that information to really be embedded at the heart of decision making at the right point when a decision is being made?
Yeah, so the first thing I would say is at the source versus after the fact. ESG is very often done by people who know that there is a regulation that is in place, potentially have hired consultants to tell them what needs to happen, and who are scrambling to get the certifications that this data is correct and accurate. And I think, like anything, getting started anywhere is a good thing. If you don't measure it, you can't manage it. And the fact that we're starting to measure it is good. But in an ideal way, if you had it as a data element that is a concern from the get-go, we know that in our client database, the ESG characteristics of clients, regardless of which type of organization we are. We know in a vendor database what are the ESG elements associated with the vendor. We know in the real estate database what type of ESG characteristics each building may have. If you have that in the metadata, then you can then slice your general ledger by client and have for free all of the ESG analysis. You can look at all of your vendor analysis and for free know how you're doing. And I think that it will give you higher quality information and much more scalable processes. And that's for me what is going to be like an ideal way for data to be done. And I'm a huge fan of focus first on the data and the frameworks. Of course, naturally, I'm a CFO. Because once you have that, you can make the right decisions, and at least you're making intentional decisions.
And from a Nasdaq perspective, how are there any examples that you can share of how investors might be demanding or using some of that information that companies are now disclosing?
Yeah, for sure. And so, for example, we talked about the fact that many investors actually care about this. And so that transparency is quite useful. And we're getting a lot of feedback, like we have a lot of engagement on ESG. And so, for example, we have a capability which is called Sustainable Lens, which is saying, hey, this is how investors would see your disclosure, and this is what other companies are doing on that. And so you're not alone if you're a CFO, and you may not want to go invent every disclosure and just rely on your judge, your investor, to look at it. You can say, okay, here are my peer groups, and let me get through Gen AI a range of things I could be saying on each topic that matches the requirements of disclosure and that are actually going to be compared by investors to those different ways of doing it that are available to me. And so that's one tool. The other thing is, whereas I believe in regulation, and regulation is a good thing, the inconsistent regulations makes it sometimes a big job. And you worry that more time is being done in compliance than in action. And so if there is a system like Metro Year One report, which we do, where you are able to give access to a tool that lets you feel all of the different requirements, because you fed your data and then the data will put it in different places. Same thing for regulatory requirements in our new Axiom SL, which is part of us. Having all of those modules use your data and then categorize it in the way that will work for different regulators around the world will enable the industry to do what is important, which is to make progress on the action and on the decisions, and not spend all of the time worrying that they misinterpreted, which is difficult to interpret, different regulations.
Yeah, and definitely that point on the regulatory landscape, I think, is another area that, of course, is changing very rapidly and continues to change. If you put on your CFO hat, are there some examples that you can share of how you, as an organization, have taken some action so that you are embedding the kind of information that's needed at source, as you were describing, and how and the kind of impacts that has enabled you to have, whether with your current role or some of the roles that you've had in the past that you mentioned in the banking sector?
So the first thing is upping the standard on ESG. whether you're doing it as defense or whether you're doing it because you'd like to, it's really important not to take risk, because this is information that will be scrutinized and should be scrutinized because it's important. And so as a CFO in different organizations, I've always wanted to make sure that the quality of my ESG information is high. That's not necessarily as easy because this is more nascent information than some of the information that is part of other CFO processes. But having a lens and working with auditors to make sure that there is very high quality processes behind the information, even if it's not yet entirely at the source. And I'm not going to pretend that every organization that I have been part of started natively at the target state, because that's not how life is. But you start with whatever state you are in any organization, and you control it very carefully. And it's processes that are very akin to the SOX processes, which we're very well used to doing as CFO. And that gives our board and our investors the confidence that we put in the right level of effort to have the right level of quality. And then I believe also that it's important to make it readable. That's why I talk about the decisions, the execution of the decisions, and then I call it telling the story. I mean, that's disclosure. But it is not just the data, it is the insights that comes out of the data, and making sure that people are using those reports as a way to tell the story, explaining the facts, and distilling the data that has been gathered. And for example, I think that in the reports that we just put out in terms of our sustainability report, we do a very good job at making it readable and at integrating some of the frameworks into one report rather than having lengthy additional disclosures that feel like something which is compliance. And so for it to be impactful, it needs to be something which is readable. And then it's something which we discuss. We discuss it at management, we discuss this at the board, and we discuss making it the right balance. And so we make it very intentional so that it's really embedded in the practices of the organization.
And if you think of some of the tips that you might be able to share that have enabled you, I think that discussion on how to, particularly where some of the reporting frameworks require a lot of granular detail, which can, some of it feel more compliance focused than strategic or really driving some of the decisions that you might want to take as an organization. How have you been able to maintain that kind of mindset, and how do you make sure you don't get sucked into a bit of a compliance black hole, which I think some organizations really feel that they are at the moment?
You know, at the risk of being in a lucky position here at Nasdaq, we consume our own products, and so those reports that I was mentioning you can be created with the help of technology. And so we eat our own cooking and we use that. And I have to say, it saves us in my CFO organization a lot of time. I don't have a very big team that does it, but they are mighty in terms of like what they can do, because they use the partnership that they have with the rest of the organization, but also the tools that we have. Again, the One Report Metrio, the sustainability lens. We communicate with our board regularly on the topic, and we have a committee that is ESG and nominating committee that has cadences, and so it's elevated also. I think you need to have the right governance to get things done, and so it has the attention of the management committee as well as the board, and that's important. And then the decision-making process is embedded in how we think about life. So for example, we always talk about driving sustainable growth. And we don't say that just in the context of sustainability. We say that in the context of having a revenue growth that is related to resilient operations, whether it's cyber, whether it is having negatively correlated business so that we can deliver value to shareholders on an ongoing basis and not just a lot of like volatility in our earnings. And so we use the word sustainability because for us, the world of Nasdaq needs to be sustainable, and it's not just about the climate, it's really about everything we do. The next thing we do is we want to attract talent. And whether you think about that as S in the ESG, or whether you think about it as the right way to become a leading technology company in the world, those are also the same languages that are being used. And lastly, I talked about the importance of the board. G, governance, communication with the board, having the right platform to communicate in a safe and secure way. Like, for example, we use our own product, of course, Boardvantage to do that, but and having the right cadence and the right level of dialogue with the board, including on the topics that are important, which happen to be ESG, but happen to be also other topics, of course, running the business. And so I think for me, ESG has much more of a chance of winning if it feels like something which is intentionally embedded in the spirit of the company rather than an after-the-fact compliance.
Yeah, and I think that point around how to create the right culture within the organization and from the board level all the way through is really critical. And I think in our barometer recently, it was clear that there's still work to do in terms of the technical developments and the ability to really integrate, have the tools, the methodologies to integrate and embed. And you've touched on some of the things that you've done to overcome that. But if you don't have that culture embedded, then you really will be facing an uphill battle in terms of actions. You touched a few times on different technologies. I'd love to hear a little bit more on that front and how you see the biggest potential for technology. You touched at the beginning on Gen AI and some of the other technologies companies might be able to use. Can you say a little bit more about where you see the biggest potential for technology to help organizations really close, whether it's the decision gaps or the transparency and disclosure gaps?
So I would say there are two types of technologies that I can think of. If you think about the climate impact itself, we need to create a much more scalable and efficient marketplace for carbon reduction. And like, for example, Pure Earth is about engineered carbon reduction, which is the highest quality carbon reduction. Right now, the inefficiency is not in the technology itself. It's in the price of it, because you don't have an efficient marketplace yet, because it's not yet adopted at scale. So Pure Earth is the leader, but it's still, and it's using a very, very advanced blockchain technology to do it. And it's absolutely recognized as the number one and being the standard. But at the same time, it's too expensive to scale. And how do we solve that as an exchange place? You get the exchange to grow and grow and grow and have more participants until the price, the bid ask, becomes more efficient. And I think we can do exactly the same thing with carbon. Right now, carbon reduction is something which is done by small teams, and it's very ad hoc. And at some point, it's going to be so embedded that it's going to be more liquid and therefore more efficient. And so that's one area where the technology and the modern technology that is behind it is there. But as it becomes more prevalent, there will be a benefit in terms of the adoption level. And then the second, it's the chicken and the egg. The adoption drives the price, and the price drives the adoption. And then a totally different part, and you picked up on my enthusiasm for Gen AI. And I have enthusiasm for Gen AI at Nasdaq on everything. It's literally in every product we do. And so when you think about the exchange, we have trading Gen AIs to optimize trading. When you think about For example, Board Vantage, we will summarize your board documents for you through Gen AI in a way that will make it more efficient for the board. But here, for ESG, and especially the E part of it, Gen AI has a huge role to take, because you want to take the data the way it is at the company. And then from that, be able to put it in the right boxes, in the right reports, so that it's correctly and accurately delivered in the expectation of regulators. And that's like a perfect job for Gen AI, which likes to look at unstructured data and actually structure it, especially if you give us a framework, which is a regulatory set of requirements. And so that's exactly what Gen AI works very well for. So we can do that, and that's exactly, then there are some like easier things to do, which is, hey, if I did that, would that change what this fund would want? Like, do I now comply with what this ESG focused fund would like to see? If I did that, would I be voted on in a better way by this or this type of, so you can start doing all of the what ifs of like, if I change this word, is that going to help? If I change that word, is that going to help? Through the lens of being owned, of being voted for, of course, complying with disclosure. And there's a lot that can be done with Gen AI, and which is what we're focused on doing. If you take also, for example, I mentioned Axiom SL, there are some ESG requirements. So we have an ESG module. But for us, we're embedding it in the products, so that it's not like you need to think about Nasdaq as being an ESG company. Each of our products will consider the ESG part that is related to the data set that we are talking about. And I think that's the important thing, is like ESG needs to be embedded and not an afterfact. And that's going to be something that you have heard from me more than once. Not an afterfact, embed at the source and build solutions and leverage technology, in particular Gen AI, so that you can then focus on your decision making and on your intention and your plans.
I think that sounds, you said the passion for that and the excitement, I think, comes through in the way that you're describing it, as well as some of the benefits. I think that they shine through really, really clearly. And back to that conversation on enabling a more strategic focus to let some of the technology do the compliance heavy lifting, hopefully. Are there any pitfalls or things that people need to watch out for at the moment? Because it's obviously a rapidly going to scale technology, but is still fairly early in its adoption.
Look, I think that all of those tools are learning. And I think what's really important is to make sure that you don't replace the humans by the technology, but augment their abilities and increase the quality of their work through the technology. And so I'm not one who thinks that you shouldn't have an ESG team and you should just have a button. I think that you need to use technology as a lens, as a filter, as a control mechanism, and also a source of information, and then embed it into your process. But even at Nasdaq, and especially at Nasdaq, there's plenty of people, including me, who read the sustainability report and who make sure that every nuance that we want to deliver is captured. There is no technology that will do that. And so the pitfall is to believe that you should just let it run on its own. And I think that whereas Gen AI has progressed tremendously, I don't think it will ever get to the point where it will replace the humans, but it will accelerate them and also increase the quality of the work for each of the team members.
Fantastic. Now we're nearly out of time. So two final questions. I think you've already touched on a few, but if first of all, if you could say a bit more about what you see as some of the key opportunities in terms of whether it's social or environmental sustainability that are getting you excited at the moment, if we look towards the future, and how we can fast track some of the things that you've been talking about.
Look, I'm really excited about the progress. I mean, we started there, and I think it's important to acknowledge that there is tremendous progress. I think the opportunity is in really now that we have done a lot of the legwork, um, having a consistent set of regulatory framework so that people can work on their decisions and their actions and really having an impact rather than having to focus on compliance or use technology in all of the right ways to supplement the humans. Um, Let us ask regulators to give us consistent frameworks so that, again, the humans can focus on doing good. I think that that is a very important thing. I think from a team's point of view, there is a great importance of ESG in engaging teams. It's a very important topic to all generations, but especially the new generations. And so this becomes a right way to attract talent who wants to contribute to the world. And people can do that through all of the corporates that they work at. And I think that investors are recognizing, as I started my comments with, the importance of ESG on the reputation. So it's not necessarily just about ESG and just about being included in a particular fund, although I think that will grow. But it's also about having the reputation of doing everything you do in the right way. And so I think that I have a lot of optimism on the opportunity to use this as a catalyst for good ESG behavior, but just good behavior in general. And I think that companies who have good culture and good reputations happen to do that too.
Yeah, no, absolutely. So final question. If there's just one takeaway that you want to leave the audience with, so that if we look 20 years ahead, we won't be looking back with regret. What's that key takeaway?
Look, first of all, the fact that we are speaking and the fact that you started this organization 20 years ago is a huge fact. And I think that the key takeaway is we haven't landed, we're just getting started. And I know you got started a long time ago, but we are still at the beginning stages. And there is a real set of topics. I talked about embedding this in the process, in the culture, at the source, in the data. And I think for me, the main takeaway that you would take from me is use technology where technology can be used. And embed everything at the source and in the way the company is operating.
Fantastic. Well, that's a brilliant thought to leave everyone with. So thank you so much, Sarah, for sharing your insights and for all of the leadership that you are doing to accelerate progress.
And thank you, Jessica, for all your leadership, because to be honest, you are a huge voice here and you're helping people to do it the right way.
Well, thank you very much. Thanks again to you, Sarah, and for sharing some of those really fantastic insights and a few great tips in terms of what each of you can do. I'm delighted to introduce our next speaker, Russell Picot. Now, Russell has been involved in A4S longer than I have, which there's not that many people who can say that. He was part of the establishment of A4S 20 years ago and has been a real leader in terms of driving action by investors, the finance world, accountants globally. So really looking forward to some of the insights that he can share. Russell currently is a member of A4S's board. He is co-chair of our Asset Owners Network and sits on a number of different pension boards, having during his career also been Chief Accounting Officer at HSBC. Great to have you here with us, Russell.
Thanks, Jessica. Very good to see you this afternoon.
And what we would love to do to get started, you've been involved in A4S pretty much since inception, I believe. So to start with, looking back 20 years, I'd love to hear from you what key changes you've seen over those 2 decades, how the finance sector has evolved in awareness and in action.
Yes, thanks, Jessica. And it's very, it's quite thought-provoking when you think back 20 years, what the world was like. I would say a couple of things. First of all, corporate reporting was very plain vanilla. Sustainability reports sort of sat very separate, almost as a byproduct of a separate piece of work in an organization with the finance department not involved at all. Back when we started in 2003, 2004, for example, in the United Kingdom, we didn't have a strategic report. That came in 2006. And I think what A4S did was to be absolutely pivotal in driving change. If you think about what the reporting and landscape is like today and the way finance thinks, the issues it gets involved with, it's been completely transformed. I think A4S has been absolutely at the heart of that. When I think about integrated reporting, we think about the 6 capitals. As you know, I'm a huge fan of that. I think it really encourages organizations to think about what they're using in their business and their strategy and their impacts on a broad range of stakeholders and the wider world. But of course, the key is not reporting. The key is thinking. And I think one of the great successes for A4S is it's driven integrated thinking. Sustainability is now on the board agenda of pretty much every organization, from large corporates to pension schemes to fund managers. And it's seen as being an integral part of modern business. And the finance function is seen as having a really important role as part of that. So I think it's been a fascinating 20 years, but I think A4S can be really proud of what it's achieved in that time.
If there were 1 or 2 things that you would like to call out that you think have been really pivotal, either how A4S has helped you in your own sort of evolution of thinking, but also on the wider landscape, what might some of those things that you think have been particularly pivotal be?
I think a couple of things, Jessica. I think one of which is difficult to overestimate has been the sheer convening power of A4S, which has been well beyond the United Kingdom. It's been an ability to draw like-minded people from different backgrounds, different businesses together, for example, in the Chief Financial Officers network, to talk about common problems and how do we tackle them. And in my world now, as a large asset owner, the same with the asset owner network. But I think it's that bringing together. It's the way that the framework which was produced, I think, really changed the way people thought about it. I think it would be quite difficult to imagine, for example, TCFD to have produced the report it did without the groundbreaking work of A4S, for example.
I think that's a good example of some of the stuff that you've been involved in personally as well. And you're obviously earlier in your career, you were an audit partner, so you bring that kind of mindset. Chief Accounting Officer at HSBC, now, as you mentioned, a pension fund chair and trustee. So you've seen some of the work evolving from a number of different perspectives, and for a moment, thinking from an investor lens. Can you say a bit more about the impact that some of the changes that you were talking about, starting with the sustainability related disclosures, is impacting your ability as a chair of a board of trustees and for the asset owner community as a whole to take different kind of actions?
Yeah, I think one of the major shifts we have seen has been the development of this concept of universal ownership. A universal owner is a large investor that typically is very long-term in how it thinks and invests, and has a slice of the overall market. And it realizes that its investment returns will mainly be driven by the overall market and what happens, and therefore it needs a functioning system. And so these sustainability issues, these systemic risks like climate change, nature and biodiversity, are foursquare within the gambit of what they ought to be thinking about. So these large asset owners, that many of the largest investors around the world are I would describe as universal owners. Obviously, the university's pension scheme I'm involved with is an example of that. And what's different about it is that they don't just focus on individual companies. There'll be mandates within the portfolio where they do focus on stock selection, but they're also really interested to understand the impact of a company on the rest of the portfolio, because you could have a company that is profitable but has a negative impact on your portfolio. And therefore, the broad sustainability disclosures that corporates are making, particularly if you think about the double materiality lens, is very important for us to understand the risks we run, but also what should we do about it? Universal owners tend to be very collaborative. We work together with other like-minded investors, and so we need these rich disclosures in order to have the information to engage with companies and to try and influence the trajectory of where these risks may be heading. As you know only too well, the trajectory of climate change and nature and biodiversity is far from where we need it to be, and we need this information to help us tackle it.
Can you give a couple of examples maybe of specifically how the information that is now being disclosed enables better decisions? Because we certainly still hear from companies questions around how useful some of the information that they're reporting really is for investors. And that's probably asset managers, but of course, you're reliant on the whole information chain to be able to get the insights that you need.
You are, absolutely. An example would be at USS, where they've recently launched and just to explain, they have a large in-house investment team. So they recently completed an internal mandate for long-term real returns. That's quite a concentrated portfolio. It's about £4 billion. But as part of the investment process, sustainability factors are fully integrated. So the decision-making process doesn't just screen financials. It tries to assess what the impact of a broad range of sustainability factors that could impact on that company over the long term, and to then decide, well, are we prepared to take that risk on? If we're prepared to take the risk on, what do we do to manage it, etc. So I think it's a very good example of, because you hear a lot about integration of sustainability into investment decision-making processes. I think this is a very good live example of how it's been done, how it's been done well and quite professionally. I think for the HSBC Bank UK pension scheme, we outsource the investment process to fund managers, and there I think, for example, the main equities fund we have is run with Legal & General, the Future World Fund, and there it's screening, particularly for climate change, and they have a process where they divest after due notice the worst performers in a sector, and of course they need that information. And actually, it's not just the information, it's also the lack of it. So if you have a company that ought to be making these disclosures and isn't, they will put pressure on them to change under the threat of divestment. So I think that those are a couple of examples. I mean, there'll be many more. I think everybody needs to do more of this, to be honest.
And certainly something that is a really big focus of a lot of companies at the moment, with that shift from a voluntary world to a mandatory. One of the other areas where you're seeing a lot more focus from regulators is around assurance. So to what extent is assurance important to you as an investor?
I think it is important. So you won't find this very surprising, but as a former chief accounting officer, I used to take my responsibilities quite seriously. So first of all, I look for internal process. Indeed, this is at the heart of TCFD. Has the company, has the board and the company properly owned these disclosures? Are they going through financial reporting like processes? As an example, has the audit committee been involved? Has the finance function been involved, to get that sense of proper ownership and responsibility? I think we're very much at the foothills of external assurance. On one of my pension schemes, we've been trialing something for a couple of years now. It's quite slow progress, I would say. But I think the sort of essential ticking and tying of the numbers is important. But fundamentally, I think what assurance won't provide is the sort of challenge, and I'm sure we'll come on to this, but the whole question of transition plans, you could get limited assurance on a transition plan. Someone could check the numbers are consistent, etc. But the judgment around whether a transition plan is a good transition plan, and is it fit for purpose? I don't think external assurance will provide that. So I think that's a question of whether the information needs to be disclosed. And I think then it's up to the investment community to challenge management over those plans. I think we'll start to see evolution of cross-sectoral comparison, so an intra-sectoral comparison. You know, all the companies, one sector investors will take transition plans and cross-check them, particularly with the use of unproven technology to demonstrate that their net zero targets are going to be met, etc. So I think we're on a journey. I think we've got a long way to go, and there's going to be different elements of that.
So from an investor perspective, you would look to external assurance for being able to trust the information that you're being presented with, along with, as you say, that important role for some of the management's own governance processes and oversight. But it's that dialogue between investors and companies and potentially other stakeholders around, actually, are the actions being taken themselves sufficient? But if you don't have robust information to underpin it, you don't know whether those actions are actually happening or not.
Exactly.
In terms of TCFD, you touched on that earlier. And I think a lot of people would say that's been hugely successful and important in terms of really driving a shift in awareness of the risk of climate change and that real shift to seeing climate as a financial risk. Do you feel like enough has been done to really understand and price that risk into the kind of decisions that you see investors taking now?
I think that's a very interesting question. I mean, I guess the short answer is has to be no. If you look at the type of different pathways that companies are using as their basis for decision making, there are big differences. You know, there are some companies who, for example, believe that there will be demand, for example, for oil and gas for a large number of years, and those pathways are likely to be highly inconsistent with the goals of Paris, and you'll get investors who believe that there will be a more rapid transition. That suggests there's different views of risk. That suggests that risk may not be fully priced into the markets, and I think part of this is the whole question of the evolution of climate scenarios and models. I think we've just sort of gone through the first 3 or 4 years of that. USS with Exeter University did a very important piece of work last year, producing 4 new narrative short to medium term climate scenarios, trying to challenge the results of the scenarios. I think people looked at the outcomes from these scenarios, thought the numbers were very small and out of line with what the climate science was showing. So again, I think this is evolution. TCFD has been massively important in terms of changing conversations in boardrooms. It was never an explicitly stated objective, but it was really, corporate reporting is a blunt but powerful weapon, as you know, Jessica. And if you ask a company to report on something, processes kick into place, and it typically goes on a board agenda. So that's been part of the success. But we've got a lot of work still to do.
And of course, the more that you're looking at or not thinking that the transition is going to happen, the more you need to look at some of the physical risks. So
absolutely,
all parts of that risk equation. I think the other thing that there hasn't necessarily been as much focus on is the opportunities of the transition and investing in that transition. So can you say a little bit more about where you see some of those opportunities lying from that net zero and also, of course, nature positive just transition?
Yeah, I think there's a couple of things which immediately spring to mind. I think first of all is the whole area of infrastructure. I think investing in infrastructure is a very natural place for long-term investors, such as large pension schemes, to focus on. They also, I think, have a natural ability to invest in new businesses, in startups, and a lot of those startups are going to be new companies with new ideas, new technologies, which we need to tackle both climate change and nature and biodiversity. But there are some things that we need. I mean, these infrastructure investments tend to be quite large. Quite often they're public-private collaborations. And it's important that the investment community has confidence in the stability of policy and indeed regulatory regimes, because a number of these infrastructure assets will be in regulated spaces. But there's no doubt that unlocking private capital to support this is going to be critical.
Clearly, sustainability is significantly broader than climate. I know one of the things that you've been thinking about a lot and thinking about what the responsibilities and risks from an asset owner perspective are in the collapse in biodiversity. And this is clearly something that the then Prince of Wales, now King, has been talking about since A4S's inception. But I think most organisations are at a much earlier stage in terms of thinking through the implications and how they can respond. Can you say a bit about how you're seeing pension funds starting to grapple with this risk?
Yes, I mean, I think there is strong but not complete awareness in the system that nature and biodiversity is a systemic risk. It is financial in nature, and therefore does fall within the fiduciary duty for pension schemes. But the problem is that tackling nature and biodiversity is a whole lot more complicated than tackling climate change. In climate change, you can pretty much boil down to greenhouse gas emissions, and they're homogeneous. Those emissions, it doesn't matter where they are around the world, within reason, they have the same impact. Nature is very, very different. So I think there's been steps to, is this something that we ought to be concerned about because it's systemic? Yes. How significant is it? Potentially, there'll obviously be sectors which are very sensitive to nature and biodiversity, as well as the generic risk to the economy as a whole. And then the question is, what do we then do about it? Are there areas of our portfolios that we ought to be thinking about? What I'm hearing from a number of my peers, Jessica, is that deforestation is perhaps one of the first things to look at. It is the case that all of these systemic risks are intrinsically linked. Climate change, deforestation has a major impact. The risk of pandemic disease is also linked. So deforestation might be a sort of sweet spot for investors to think about, not only in terms of direct investments, but also in terms of exercising influence over companies that sit on top of supply chains that have deforestation as an issue through that supply chain. So that's my expectation, is that we'll see perhaps the first surge of activity around deforestation before it then matures and broadens out.
And of course, you mentioned the blunt stick of reporting and mandatory disclosure, and of course, it's already being required in Europe. The IFRS Foundation and ISSB have indicated that biodiversity and nature is going to be one of the next suite. And of course, we have the TNFD's insights and framework that organisations are already starting to adopt. So I think definitely you can see some momentum building. If we look ahead and look at the scale of capital that needs to be deployed, whether it's around the climate side of things and the transition to net zero, but more broadly to achieve the Sustainable Development Goals, so social and environmental outcomes that we need to reach. Can you say a bit more about where you see some of the key levers that could help to scale up some of these investments to the level that they need to be at?
Yes, as I said earlier, Jessica, I think it's the essence of the problem is going to be tackled with a combination of public actions and private sector actions. The private sector cannot solve these problems by itself, and there's things that the governments can and should do. So having policy which is consistent long term and actually supports tackling these areas is I think critical. That means looking at fiscal incentives, for example, to make sure that they are properly aligned with those goals. I think they are very important because they then create the environment that investors can then use to then swing behind those government initiatives. So, for example, having clear pathways of how a country will decarbonize over a 30-year period should give investors confidence then to come in and support those pathways. But those pathways need to be supported with appropriate policies and incentives, and that can be challenging, but I think it is a prerequisite for us successfully challenging this. And obviously on the international scale, that's just as true as it is on a national scale.
Can you give a few examples of where there are investment strategies or collective action by the investment community that you are seeing as having a tangible impact in terms of closing that financing gap?
I think some of the thinking around not just tackling the transition in the global north, but the global south, I think is starting to come. I think that's quite a difficult area. It's not a natural place for most asset owners to be investing. It's more challenging. So I think some of that we're seeing. I think in the UK we're seeing for DC pensions, we're seeing an emergence of long-term asset funds appearing as part of the default. Both USS and HSBC have those. So that's starting to redeploy capital into these longer term types of investment that would be critical. And those mandates tend to be international. Obviously, that means that we need to upskill fund managers, but I think I'm quite encouraged by what we're seeing in those spaces. I think some of the international collaboration is obviously around seeking better engagement, etc. at the moment.
And if you think of some of the work that that we're doing at A4S with the asset owner network, which of course you chair, and with banks or asset managers or others, what would you like to see them doing that is going to help to accelerate action? Are there one or two things that you feel are particularly important to focus on?
I think they inevitably in these networks you're going to have a relatively small number of pioneers who are ambitious. They've got the resources, they've got the collective will to tackle these. I think one of the great things about these networks is the openness of sharing, because they tend to, certainly in the investment community, for the asset owners, this isn't a competitive landscape. You know, we're not trying to outperform each other, the large pension schemes. So what I would like to see is that the sharing of the early movers actually achieves more rapid transmission through the system, such that you then get a much faster deployment of capital behind good ideas. I think the evidence is that that's been quite patchy so far. So I would like to see that happening much more significantly. Probably the whole nature deforestation space, for example, will be an early test of that, I think, Jessica.
Yeah, and that's definitely something that we're giving thought to over the year ahead, of how can we really help to fast track some of those areas that are getting to a stage of being really tried and tested, and the pioneers that you mentioned have demonstrated that they are effective, that they're within fiduciary duty, that they, and therefore, you know, can be really taken to scale and adopted by others. Now we're nearly out of time, so if I could just ask one final question. If we were to have this conversation in another 20 years,
what would you hope to have seen happen over those 20 years? And if you were to leave the audience with one final takeaway, what would that be, so that really that vision that you might have for the future will have been realized?
So unsurprisingly, Jessica, I'm going to start off with tackling climate change. So in 20 years' time, we'd be standing and we would be celebrating the rapid decarbonization of the world's economic systems, such that we have avoided the worst aspects of climate change. In 20 years, if we continue with this very dangerous experiment we're running at the moment, we are likely to see at least one of the climate tipping points trip. So I would like to be celebrating we haven't had that, and I would like to see real tangible evidence that we have stepped up to preserve nature, and that the worrying trend of loss of biodiversity has stabilized and has improved. Then I think we can be proud with what we would have achieved.
Fantastic. Well, thank you very much, Russell. We really appreciate all of the work and leadership that you've been showing for the last 2 decades, and look forward to continuing to work together as we take action for the future.
Thank you, Jessica. It's been my pleasure.
Huge thanks to Russell and also to Sarah for sharing their insights in how we can finance the future. Do come back with us in about an hour for the last session in today's A4S Summit, where I'm going to be speaking to Mark Hawkins and Robin Washington, 2 real leaders from the finance world, to explore developments over the last 20 years and how we can fast track action into the future.